It's Christmas, everyone. So Merry Christmas. And after I take you through the account, I'm going to talk about a revelation I had about overvalued stocks and growth companies. And I think I'm finally understanding why people are spending so much money on companies that have not made a dollar yet and probably not going to make any dollars in the next 4 years or 5 or longer or never. So I'll talk about that. But first, let's go into the account and I will show you what's going on. Here we go. I'm sitting at an all-time high, $145,000. Super cool. And here is the weekly chart. This is what it looks like, up 1%, which is not that impressive, but probably doing better than market. I haven't checked. Well, let's check. So 1 month is 10%, 3 months 26%. Let me see what the S&P via the ETF SPY is doing. So 1 day, the week is negative 0.53. So I'm definitely beating the market by a couple percent, almost 100% beating it on the month. Only 1% here and beating on 3 months as well. So that's great. I'm doing better than the market like usual. I like to see that. If you all know this channel, if you've been following these video logs, I'm really happy when I see that. So that's the performance. I'll take you through the account really briefly so I can show you all the positions, and you can see starting with my options here at the top. This is the symbol, the strike price, the expiration date, how many contracts I have, and whether it's a sell or a buy. And from that, you can deduct all relevant information you might want. You can pause the video at any moment to try to review these options positions. Definitely rolling off a lot of these options right now. So I'm just collecting the premium, except of course the Apple options that I have, the YOLO calls, leaps options that I have on Apple. And here are the equity positions. Still trying to accumulate some O. Unfortunately, I had to sell some DEM, the emerging market dividend fund, because of an options play. So that's that. But I'm having the dividend reinvested right now, so I'll be purchasing another like half a share or something, almost a full share because of the dividend. So now I have 111 shares instead of 211, unfortunately. Energy fuels. I know uranium's been on a tear, but I haven't actually owned these shares here. 2,500 shares I wish I had. I sold through option contracts, and now this is what the position looks like if you're really interested. So I sold at $2.50 and $3, and now it's $4.16. So here we go. Look at this. So total return almost $6,000, but look at this total return minus 3,555. So only really benefiting $2,000 out of my entire energy fuel play instead of 6,000. But that's that. You know, I wanted some premium and protection from downside, so that's what I get. And that's about it. If you noticed, down here I have, oh, I think I'm gonna sneeze. Maybe. I have Fisker. And Fisker, oh my gosh, I hate when this happens. And Fisker went bankrupt once or twice before, and now it's re-emerging through a SPAC. So it's back on the market, and hopefully they make it right this time and profitable. It's definitely a Hail Mary. I mean, and that Hail Mary is already pretty expensive. I mean, it's worth like, what's the market cap here? $1.15 billion for a Hail Mary. Doesn't make any money. So right now it's just burning through some cash, even though that's not what the statistics say. I don't know how they got 1.3 million, but whatever. Probably selling tax credits, am I right? So anyway, I've been looking through this company. So here's what I want to talk about, right? So you already know. Actually, let me go to the account tab so you can see the account. See how I've been accumulating cash and why I've been accumulating cash. I have $14,000 and almost $400 now in cash. just sitting and waiting. I have 121,000 purchasing power. $121,000 purchasing power. This is my total return. My account based on total return, and then this is based on equity. The only losing position really I have is energy transfer. That's about it. But that could change. I mean, hopefully natural gas pops up, and energy transfer is supposed to be bad under the new administration because they could prohibit one of their major pipelines, but I wouldn't know if that's going to materialize. So I'm kind of betting that all that risk is kind of priced in, and we'll see what kind of falls, how the chips fall when it's all settled, if it's all ever settled. Sometimes it never settled. But anyway, I want to talk about my topic today, which is how and why I'm finally getting used to these super expensive like growth stocks, and I can kind of see the logic now and why people do it, and why they spread their money out through some Hail Marys and growth stocks with a good story and let it ride, because all the regular stocks that are out there and make money are so damn expensive. Like, I was going through this list and I was gonna make a movie or the video about energy transfer, or like Wheaton Precious Metals, or some other company, real estate company and whatnot, but all of their PEs are like 20, 30, 40 plus. Like Apple's is 40 something, and that means that at current earnings rate, it would take 40 years for the company to pay for itself, for the investment to pay for itself, and that's just way too long. But obviously Apple's earnings are going to pop up a little bit and that PE is going to come down. But my point here is that it's very hard to find a company that's not priced at an extremely high level. And so you might as well, in order to have a chance to have a reasonably priced company, you might as well buy one from the start when it doesn't have any earnings yet and has the potential to grow into a company that's decently valued, right? So let's take Fisker, for example. It's it's a $1.15 billion company, market cap, but it could be as big as, let's say, maybe not GM, but half of GM, for example, if everything works out well. So that's $30 billion company, and so that's 30x return. Yeah, and now that makes sense. You're betting for a 30x return, and you bet on, let's say, 30 companies like that, you may make your money back. You have a good chance of doing that. And so I'm starting to kind of understand this gambling game that's been going on, because there just isn't a very good reliable way to make money in this market, especially when it gets overvalued like that. So perversely, whenever the market gets overvalued, it gets riskier. Okay, so that's the big revelation here, is that it pushes in investors further into the risk range. And so what shouldn't be happening when the market's overvalued, which is investors going for riskier plays, is exactly the mechanic that ends up playing out. And I'm sure that the reverse is also true, right? So whenever things are depressed, whenever stocks are at a low, nobody wants to buy the Fisker Karmers, or the Fiskers of the world, and all these companies that are popping up that have no revenue and have not a very good prospect for the future when it comes to earnings, and it's kind of a Hail Mary, right? But at the bottom, when they're least overvalued, when people should be scooping them up and making that same 30-1 bet, they're not making it. They're looking for companies that are making profit, that have a chance to survive, and that's just the opposite of what happens at the top. So it just kind of really struck me, but I'm not changing strategies. Like, I'm not gonna go all of a sudden start buying up growth companies, but I can at least finally understand it. So let me know what you guys think about this. I'm just really curious if anyone has any thoughts on this kind of market dynamic and behavior at the tops, and why people elect at these odd junctures to pay an exorbitant amount of money for companies that have no profit whatsoever. And, you know, if you think the mechanics will reverse when stocks are at the bottom. So I'm curious to hear your commentary. I'm not going to spend too much time yapping out here about growth versus value or anything like that. But by the way, all the stocks that I looked at, Visa, Wind Precious Metals, Apple, and all the stuff that I own, Realty Income, etc., their P's are sky high. And I just can't see myself like buying anything. And that's why I'm starting to accumulate, because I don't want to write any more contracts into this expensive market. Right? How am I going to write puts and try to accumulate the stuff when the PE is that high, Like Realty Income, fine. I can acquire this price somewhat, $60, but it's still pretty expensive, and there's no way I'm buying Apple at these prices, right? Any more Apple than I already own. So, I'm starting to understand. Let me know what you think about it. All right. And whether or not you have that strategy, especially if you have that strategy of growth stocks, let me know if how it's working out for you and when you decide to do it. All right. I'm going to end it right here. Merry Christmas. And if I don't make another video before New Year's, Happy New Year too. And I'll see you in 2021. Actually, I'm going to make a video I want to do a recap of how much I've been earning during 2020 and break it down by month. And I'm also breaking out by income source too, which is going to be kind of interesting to pay attention to. So I'm going to calculate how much I'm getting from premium, how much from dividend, how much from trading, buying and selling stuff, and how much from capital appreciation and all that. Okay, so it's going to be an interesting episode, so try to not miss that one. All right, for right now, so I got for you. All right, peace out.